Welcome to BizTech's ASEAN Midday Market Watch. Our guest today is Jeff Halley, Senior Market Analyst, Asia Pacific at OANDA. Now, Jeff, good to have you on your show again.
Always a pleasure, mate.
Now, let's take a look at how markets in the region are performing. It is an absolute bloodbath, a sea of red. But starting off with the SGX, which is at 3,159.69, it's down 0.71%. Bursa Malaysia is at 1,574.81. It's down 0.58%. The Nikkei is down 3.06% at 28,608.14.60. The Shanghai Composite is at 3,418.89. It's down 0.27%. The Hang Seng is down 2.15% at 27,982.21. The ASX 200 is down 1.03% at 7,099.10. And rounding up the numbers, we've got the Kospi, which is at 3,205.03. It's down 1.34%. Jeff, what's the reason for this steep declines across the region?
Yeah, it's part of the sort of wax on, wax off markets we're seeing at the moment, where they're really looking for a strong direction, but can't really buy into a theme. So we saw the non-farm payrolls on Friday were a huge miss, and nobody was talking about inflation. Yesterday night in New York, everybody was talking about inflation. We saw US yields move slightly higher, particularly in the 30 years, and that seemed to spark off some selling in equity markets. Goldman Sachs also put out a report last night saying that the biggest risk to technology stocks, these FANGs or FAMs, I guess you call them now, if you swap out Microsoft for Netflix, was regulatory, which I completely agree with. Their biggest risk to their business models is increased regulation. These Goldman Sachs reports seem to be carrying a lot of weight at the moment. They put out one yesterday saying that commodities are all going to rally quite substantially in the coming part of the year. And we saw 10% rises in iron ore and steel rebar futures in China. So I think that was sort of like the straw that broke the camel's back of a nervous market. And we saw a big run for the exit door, which has continued into Asia, because we can see NASDAQ futures are still 1% lower. And on the NASDAQ, it has actually broken its a support line that goes all the way back to March 2020 last year. So it closed below that for the very first time since then overnight, and also closed below its 100-day moving average. So although the Dow Jones and S&P have plenty of room, the NASDAQ is looking vulnerable right now.
But could we say that the big tech sell-off overnight is kind of overdone, because the same things happened in China as well? The markets have obviously been spooked by the increased regulatory scrutiny of Chinese stocks in China, obviously, and that still is that perhaps unwarranted in terms of the big tech? I know you say you agree with it, but big tech in the US goes through these cycles over the years. It's been Microsoft before, it's been Google, it's now Facebook, and now it's a little bit broader. Are we reading too much into this?
Yeah, look, I think it was a quiet news day. Market valuations are extended. If NASDAQ was 10% lower and people were buying the dip, this would have all been completely ignored. It's all about timing, and it's just that those things came together to create this perfect storm, if you like, last night. US technology companies have always adapted their business models as new rules have come in, and I'm sure they'd do the same again. I think the big difference here is that China has actually been regulating and fining and getting tough physically on big technology in China, whereas it's just nebulous talk in the United States and to a lesser extent Europe. So I think US is really the big one. If they start regulating big tech in a more material way, that would be a strong negative in the short to medium term. But again, I think it's really ebbs and flows in sentiment with markets at very extended valuations and a lot of nervous Nelly longs out there.
Now, this morning we had a China Consumer Price Index for April coming in 0.9%, slightly missing the 1% forecast for Analyst. Factory gate prices, however, data came out and showed the fastest rate of increase in 3.5 years. Now, is this an example that the real economy inflation worries are now translating into the macro data?
I was pondering this one this morning, and often it's been that these increased factory gate prices haven't translated into the price of finished retail goods that land up in, I guess it's the e-com shops these days, not the shop shelves that we go and walk around in. So, I mean, the jury's out on this one. Will those price rises get absorbed this time around, or will they be passed on? I just don't think we know at this stage. So, but I think
Jeff, one of the things is the fuel in the fire is commodity prices.
yeah, but we've had mad commodity price rises before. I mean, the world was functioning perfectly well when oil was $140 a barrel, but here we are at 70, and people are getting nervous. So I think some of this stuff is a little disingenuous. I think we're seeing price stresses all through the system now, and as major economies around the world sort of reopen as their vaccination programs move towards the end game, we're going to see another push there again. But it won't be even. Some parts of the world are going to suffer less than others in this respect, or suffer more, I should say. But as I said, I just don't know whether these Chinese manufacturers are going to suck it up and absorb these costs. But what they can't get around are the costs and logistics. I mean, there's just no way to escape that. So whether this inflation is transitory or sticky is yet to be seen, but we're not seeing a wage price spiral anywhere. And frankly, unemployment is still a lot higher now than it was this time last year. And I don't really see that happening. So I think, inflation is going up for sure. Whether we've finally reached a turning point in inflation after 30 years, I just don't think we know yet.
Now, okay, you brought up a very interesting point about the COVID and vaccination rollouts and so forth. Two countries which are not really participating in this whole recovery story globally are Malaysia and the Philippines. Now, their GDP data is out sometime today. Expectations are that Malaysia's would shrink 2%, Philippines 3% for the period January to March. What's your view on this?
Yeah, the Philippines data came out slightly worse than expected, but that was due to a couple of factors. One, of course, these constant COVID-19 lockdowns that they're having, which are just destroying domestic demand, but also swine flu amongst their hog stocks in Malaysia, where it's a staple food, and they've had to put a lot of those animals down. So that's also decreased.
Philippines, you mean, yeah. Philippines.
The Philippines, I mean, yeah. So there's a couple of factors there. Malaysia, again, has had a series of sort of movement control orders. It's definitely going to take a hit from this one that we saw announced overnight, which is basically closing up the country for another whole month, right across the end of Ramadan and Eid as well. But I believe that the Malaysia outlook looks better because it has a more diversified economy. It has its raw materials. It has national champions like Top Glove, and it has also a higher, a richer domestic base that has more spending power as well. So I do believe that Malaysia is very much a cyclical recovery play, even if it has a few bumps along the road. But I think really it's going to really depend on how these countries and Indonesia and Thailand and a lot of these other places around ASEAN manage COVID-19 over the next month. If it makes a big comeback, we're going to have to reassess that argument. But if these lockdowns, etc., succeed, then I believe their cyclical recovery will be on track.
Now, Jeff, thanks again for coming on the show.
Always a pleasure, Brian. Thanks very much.
Now, we've been speaking to Jeff Halley, Senior Market Analyst, Asia Pacific at OANDA on BizTech's ASEAN Midday Market Watch. I'm Brian Fernandez. This video will be on our Facebook and LinkedIn sites, as well as our website, www.biztech.asia. Please subscribe and like our Facebook and LinkedIn pages. Thank you very much for tuning in.